Hello and welcome to your Monday Futures Market Outlook for June 28th, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available, no credit card required. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles the market has gone through. About 6 months ago, we crossed above that 80-week moving average, giving a bullish signal on the upside, and the question really becomes, is this a legitimate breakout above this line that will mark a multi-year trend, or will it be just a false signal above that will get us right back down below that 80-week moving average in the upcoming months? Well, we favor two scenarios in the way that it's going to play out. The first scenario is a more bullish one, which I think is the more likely outcome, is the fact that we spend the summer consolidating lower, more than likely even hitting lows around the 950 to 1,000 level on the downside of the S&P. Subsequently, into the late summer and fall, we find some short-term lows within the marketplace and use that as a springboard to launch a rally into the end of the year, holding more or less above that 80-week moving average. Now, even though we favor that scenario at this stage, the one thing we simply cannot rule out, and that's why we're looking for further evidence into the summer, is the idea that this entire rally that we've had up until now is one very big retracement of that bear market in 2008. If that's the case, that this was nothing but a secondary move and a primary downtrend, then the resumption of the bear market could ensue here. Now, again, we don't think that this is the highly probable outcome, but at this stage, technically, you certainly cannot rule it out. When we take a closer look at the S&P 500 using the daily charts for the E-mini futures, what we have now seen was the market reach our upside retracement zone that we marked off, an area that we felt the upside of the market was going to achieve. Subsequently, as we approached that 1120, 1130 area, the market began a very strong 3-4 day market pullback. It's now approached a very important level right at the bottom of this retracement zone, creating this almost flagging formation. This is almost a critical moment in the market, because if the bulls cannot dig in and hold this area, then we'll have a pretty fast drop down towards that 1040, 1050 area on the downside to test down those support lines. If that level is tested and then the 1040, 1050 area for whatever reason was not able to hold any selling, then measured moves on the downside are all the way down into the 960 to 1000 area. So really, it's so critical at this moment that the bulls dig in and give a bounce in this market. Otherwise, there become a whole number of bearish outcomes that could really play out. Now, if we get a bounce off this level, there's two ways that this can play out. Number one is that there will be another full retest back into that upper blue box, the retracement zone. That a rally from this point higher could easily not only retest the previous highs at 1130, but could even go 1140, 1150 on the upside before rolling back down. That doesn't make us bullish. It just simply means that the market is finishing this flagging wedging formation for a further weakening into the latter part of the summer. But the one thing we'll be watching for, even if we get a short-term bounce, but it's failing below the 1100 level, we're going to be watching the 1090 and 1100 levels with a lot of interest, because if we see a failed rally attempt, especially if it only lasts 24 to 48 hours and it rolls right back down, then we could find ourselves even by the end of the week or early next week down at the 1040, 1050 level. So at these technical levels, we're going to get some very important information. Just to review our key points, our thesis since January 2008 has been that we're in a secular bear market. We have not changed that thesis, and we won't do it until we see the extent of the sell cycle that we're currently in. If, again, we see some very good consolidation into the summer and those levels around that 950,000 level holding on the S&P, then we would actually change our thesis to a more bullish outlook on the marketplace. In the same regards, if we get under those levels, when some selling really starts to deteriorate the market, we will maintain the thesis. Right now we're looking for evidence to see if the S&P has officially done its retracement onto 1120, 1150 area, or if we have to go up there one more time to retest that upper zone. One way or another, we believe that any rally here is on only a short-term scale, and we're very skeptical about its sustainability into the summer. So we believe that investors and traders, it's important to stay conservative in any investment portfolio. Next year, I want to take a look at the NASDAQ 100 using that E-mini futures contract. The technology-driven NASDAQ has held up support lines much better. It's right now right at the key retracement levels drawn on by this blue box, and more or less, it's going to probably mirror what we were talking about in the S&P. Either it's going to break this level, come right down to that 1740, 1770 level where the last previous lows all occurred, but any bounce from here could have us right back up into the 1130, 1150 area on the upside. So we're watching to see how the bulls and bears play out this line of support. Next year, I want to take a look at the U.S. dollar index futures, and the U.S. dollar is nicely consolidated right into that 85.50 to 86 level, but as it did, it attempted to hold that support line and was not able to muster up any rally whatsoever. This is really going to take a cue from the euro. If the euro gets above the 124 level on the upside and makes an attempt to move all the way back to the 126 to 127 level, subsequently the dollar index should weaken, maybe even as low as the 83 to 84 level on the downside. So really we're watching for the euro to give us the cue above the 124 level if we're going to be looking for a breakdown of the dollar index. In the same regards, if the euro starts to roll over, and especially even the British pound, if we start to see those support lines breaking on those currencies, then we could actually still hold the support line here in the dollar index. Next year, I want to take a look at the futures contracts on gold, and gold continues to march to the beat of its own drum. It's really got a very distinct uptrend in place, and it's been etching its way higher. Really, at this stage, we continue to have a bullish bias. Any technical breaks now above these high zones right up in here would still open the window for a move to 1275 to 1300. There are some different measured moves that actually indicate even a move that could go even as high as the 1350. But for now, we're just would be happy to see gold officially hold above these previous highs and show some sort of momentum that it's ready to keep going higher. Anybody that's looking for a gold pullback rather than a breakout on the upside, recognize how important that 1210 to 1220 area is on the downside. Anything that even now breaks down to that level and still holds that in the line of support would still actually turn bullish. So we would anyone that wants to be bearish on gold really needs a strong technical push below 1210 to have any major sell signals starting to come in on gold. Next year, I want to take a look at crude oil futures, and we're seeing this rising wedge formation on oil working its way up to our targets around that 79.80 level on the upside, the top end of that retracement zone. Again, this is going to be a big play on what happens with with all the different currencies, because if the dollar index continues to consolidate, we could theoretically see oil work its way all the way back up to the consolidation zones in the 82 to 84 area. But really, we continue to be skeptical about the sustainability of oil and think that as soon as the currencies finish unwinding their oversold states, we would certainly see a resumption of some selling in crude oil. It'll be very interesting to see whether or not we get a move temporarily, maybe up towards the 82, 83 level, and then quickly get back down below 80. It would only happen if the dollar index was to break solidly below 85. But again, we wouldn't be looking for this to sustain itself. Finally, when we look at the futures contracts on the 10-year Treasury notes, we've had a very distinct uptrend on the upside, and we had a technical breakout above this trend line right over here, indicating that there is some upwards momentum building for the 10-year Treasury notes. But I don't think it's very likely that the Treasury notes are going to be able to do this without all of the other markets making some sort of significant move. So I continue to be a little bit cautious at that 122 to 122.5 support line up above. So we're going to be watching what happens as it tests up in there. We could very well see hit into the 122 area, a reversal that comes back towards 121 or the 120.5 area on the downside, finds the support lines there, and then as the currencies start making their major moves, then 10-year makes a legitimate push above the 122.5 area. So even though we have a nice technical break, there's still room for this to come back for a retest of trend line. That was your Monday Futures Market Outlook. Thank you for joining me.